same categories. So if there is troubleshooting that needs to be done, this is going to point that out to you immediately. Because they've given you the numbers, you compare them to your numbers, and where you badly disagree, that's where your problem is. So there are some very good tools for fine-tuning this. Okay, so, I have the class kind of get used to reading these things. Here's a question that you have to think a little bit about. If the gross margin were 25% instead of the actual 50%, would the company have made or lost money without doing a lot of calculations? What can you look at? What can you do to give you a very quick answer to that? Okay, what I would do, now that I know the answer, look at the net operating profit, $206,000, 207 almost, and then take the gross margin and cut it in half, because it's only 25%, it's not almost 50. So you've got what, $270,000, and that would be the amount of money you're not getting. So you compare that to the $206,792 that you did get, your profit, and it would have wiped it out. So you very quickly know that there's some room for, fluctuation here, but you're not rolling in the dough. Now there's another thing that may be getting a little bit too granular, but there is no income tax on this profit and loss statement. The reason for that is that this happens, look at the very top, Boiler Up Products, LLC, which means a limited liability company, and this is the most recent form of a corporate structure that protects your personal assets from being attached in the event that the company gets in trouble. There is what's called a shield around the company that cannot be pierced unless there's been bad behavior. And that means that if somebody sues your company for more than your company has, they can't jump over and take the money from you. And that's why it's so important that things like this be displayed, so that everybody's on notice that this exists, that you're protected by that corporate shield. Very important thing. You can become an LLC in the state of Indiana I recently started another one. I was going to say for under $90, it cost me $100 this time, but for $100, you can have this kind of protection from now on. And it is so worth it because, if you had a retail business and somebody comes walking into it in bad weather and slips and falls and breaks their back, the first thing they're going to do is sue everybody in sight, and it'll be you. No way around it. And you just want to be sure that they can't come and get your car, come and get your dog, come and get your home. I was kidding about the dog. But you want to protect yourself any way you can, and this is the way to do it. So $100 is the best money you'll ever spend just for being able to sleep at night, because you never know what's going to happen. And society today is so litigious. People, there's a lawyer on every corner. So anyway, so then you finally get down to interest expense. We talked about that, the net operating profit, and that's really all there is to it. Every income statement you see will look similar to this. Now for a huge company, each of these sections could be 2 or 3 pages, but still the same information, it's still used the same way. And so it doesn't take you long to, with a very little effort, to get good at reading these things. So let's go to the next page, which is, lo and behold, the very same information, but now it's by month. Now your shareholders may not be that interested in this, but I'll tell you what, your managers will. Because this, by getting this information monthly, they can begin to spot something that doesn't look right, that doesn't feel right. They can begin to start figuring out, what do we need to do? And so that's exactly why companies prepare these. And if you look, I mean, you could tell, this is a little misleading because this was a startup. And so the question was asked, can you tell if this was a seasonal company? And the answer is, well, maybe you can, but because it was a startup, that may kind of cloud the issue a bit. It makes it hard to make that determination. But all this lets you do is see down to, we know that our business expenses are out of whack by looking at last year's. So where do we start trying to figure out what the problem is? Well, you have all the detail here, and you just begin digging into it and figure out what in this looks different from the one in the prior period. And so that's how these things get used. A lot of bookkeeping is done using Excel, and it really wasn't meant to be a system to keep books. It was meant to be a spreadsheet that did everything. And there would be those that say that once you get to a certain size, Excel is not where you want to be. But until you get there, it can be pretty valuable. What we use for our class is something called a financial projection model. And that's where all these numbers came from. And you don't really have to know anything about accounting to generate these numbers. You just have to be able to fill in some worksheets and let the system take over. Now, admittedly, there's a fair amount of programming in that, which Excel will let you do, but it does an awful lot of work for you. Any questions about the P&L? Okay, let's go on to page 5, and here we are on to the most important sheet for a startup business, the cash flow. And it's just answering that question. Are we cash flow positive, good thing, or cash flow negative, bad thing? If we're cash flow positive, do we have a cushion? And if we don't, that is saying to the management team, you had better be careful because we're skating on thin ice. And if that ice breaks, we're not very far from, going in the deep. So cash is king. Don't ever run out of cash no matter what. Because I was very new to being a corporate executive at the age of 29, I hired the meanest son of a bitch to be my mentor, and he was ideal. He just scared the hell out of me, and that's exactly what I needed. And he would come in, he didn't want to have any pleasant talk, he wanted to look at the cash flow. He'd look at it and say, "This is horrible, this is horrible. You're not collecting the money you should be collecting. You're not doing your job, Mr. President." He would do, all these theatrics. But I'll tell you what, it got to the point where when I knew he was coming to town, there wasn't any question I couldn't answer. And I tried to make the answers as good as they could be. But anyway, take a look at this. This begins with a beginning cash balance, which theoretically would agree with a bank statement. So you can see the beginning cash balance in month 1 was $125,000. And notice as you look to the right, it keeps going down. Well, that's not unusual in a startup business because the $125,000 had been planned. I mean, you can the model, this model, will tell you how much business you need, how much cash you need to put in the business to survive this startup period. Now, you can make a mistake, you can be inaccurate, but it's better than zero. It's better than nothing. So you'll notice that it starts with the cash inflows, the income from sales, accounts receivable. That is where you are giving your clients a period of time to pay their bill. And this is very, very normal in manufacturing companies because it's typically a lot of money. And so you're giving them, and if you're smart, this is in writing, and they've agreed to it. If you're dumb, it's not. Because the fact that you're not showing much concern about getting paid by not having these things in writing, in a legal document, they're not going to be at all upset about not paying you. So you have to let them know this is how we do business. And give them some leeway, but don't let it become, an ever-increasing leeway. So anyway, you'll notice that the accounts receivable, the cash received from accounts receivable, was based on over what period of time you've given them to pay their bill. And if you've given them up to 90 days, you're going to see that reflected in this number all the way across. Now, to make it easy, it's the same number. Well, then you see you have things like cost of sales, which comes right off of the profit and loss, change in inventory, which is a calculation based on you're increasing or decreasing the value of the inventory asset, and that has to be reflected. If you're increasing, it's going to be money out of the bank. If you're decreasing, it's going to be relief from taking money out of the bank. Salaries and wages comes right from the profit and loss you just saw. Business expenses come right from the profit and loss. Income taxes, I kind of missed the point on that before. We don't have income taxes in an LLC generally because what most people do is they have the income allocated to the ownership and the owners take it into their personal taxes. And so you will often not see an income tax number for an LLC. They don't have to do it that way, but a lot of them do. Loan payments comes right off the P&L. So I mean, these sheets are all related to each other. They're just organized differently based on the information it's trying to show you. Okay, we're doing pretty well. So you'll notice the ending cash balance was negative every month and in a fairly healthy way. And you'll also notice there's a line that says line of credit drawdowns. This model that we use automatically, when it's putting this piece together, if your operating cash balance is negative, based on these calculations, it's going to assume that you have a line of credit and it's going to draw down enough money to keep you in the black, meaning you're not in a negative balance with the bank. So what you will normally do is when you're first putting these statements together, you will not figure out what that number needs to be starting out. You will let the system tell you. Then the next thing you should do is try to look for ways to make the numbers better. And once you have done everything you can there, the next thing you do is you then decide how much money do we want to ask for from the investors or the bank for working capital. which is the amount of money you're going to need before the business is throwing off enough cash flow to run itself. And that's what your goal is. So that kind of explains all that. Then we have a couple minutes to talk about the balance sheet. And that's on page 6. And you'll notice it's divided into 3 main sections: total assets, liabilities, and owner's equity, which by definition is the difference between the two. And so I told you that a seasoned investor will come down and look at the balance sheet, because that will tell him or her whether or not the company has been making or losing money, because the owner's equity section, if it's a negative number, not unusual for the first maybe year or 2 in business, but beyond that, it's a bad warning sign. It means you have not turned your business model into making money, and that's not a good thing. So anyway, that's really what this is for. Any questions? I realize this is a lot to throw at you. But this is typically, if you go in to borrow money, a bank is going to want to see this. And they're going to need somebody who can answer questions. And that's why it's kind of key that if you're the president and you don't yet have a chief financial officer who hopefully down the road a little bit is a CPA, that person would do that for you if you had them. If you don't have them, it's pretty much up to you. The bank is going to look to you to be able to answer these questions. And then I think the one other thing, we're beyond time now, so I think the one other thing isn't that important. So thank you for your attention, and good luck to you.